Hello and welcome to this Airlie quarterly update. My name is Jennifer Herbert, Key Account Manager at Magellan, and I'm joined today by Matt Williams, Co-Portfolio Manager for the Airlie Australian Share Fund. Welcome, Matt, and Happy New Year.
Happy New Year to you as well, Jen. Unfortunately, we're back filming these quarterlies from the home office. I would have thought we'd be through this, but this COVID thing, it's proven very persistent.
Very true. It's not quite the same as seeing you in the person, Matt, but I guess we need to make do.
We will.
So, Matt, it's that time of year when resolutions are made and then promptly forgotten. It's also the time of year when we see many articles, tweets and podcasts from investment commentators and pundits offering up predictions for the year ahead. Do you care to join the fray?
Yeah, look, I spend a lot of my Christmas break, Jen, reading all these predictions from pundits and commentators. I find them really interesting. I guess people who I've spoken to over the years would know that I generally dismiss macro forecasts and predictions as not very helpful to investing and running a portfolio. But I sort of was interested over the break that the well-known sort of academic entrepreneur, businessman Scott Galloway, or Professor Galloway, he made a really good comment as he loaded up his annual predictions, which he does every year, and they're a great read. But he said the value of a prediction is the act of making it, not the prediction itself. And contemplating what may happen encourages us to take responsibility for decisions we make in the present. And then when we later on we see how that prediction has gone, and we can measure ourselves. And it's a way of measuring ourselves and measuring our progress or actual not. So I thought that was a really interesting way of looking at the purpose of making our own predictions. When I look at the portfolio of the Airlie Australian Share Fund, there's two types of predictions that can be made, macro and micro. Macro predictions, as we've talked about, as I've mentioned many times, we think are generally useless. And hence why we give ourselves a 10% cash limit in the fund. To stop ourselves from trying to make a big statement with a lot of cash. So in our opinion with macro, there's too many variables and impacts for a clear path to investment success, and timing can be everything. You can be right on your big view around currencies, around economic growth, around share market direction, but if your timing's wrong, then you're just wrong. But in terms of managing a portfolio, these big issues or big narratives, big macro narratives need to be tracked, explored, and we do sensitivity analysis for the portfolio just to make sure that we're not taking any unintended bets or we're caught short anywhere. On the other hand, micro predictions, I define as company-specific predictions. Now, these are much easier to ascertain, research and talk about, and really this is what we do when we analyse companies. We're looking at industry and company-specific micro influences, and we combine those with valuation and return analysis to help us predict whether a company's prospects are better or worse than what the consensus view is. So, for example, when we look at a portfolio holding like Dicker Data, which distributes hardware, software and cloud technology for many global tier one tech companies here in Australia and New Zealand, and we gather up from industry data and our conversations with all companies throughout the listed in Australia, the digitisation of the end-to-end processes for companies is just continuing apace, and the runway is long. So we think the future looks fantastic for Dicker Data, who's maintained great relationships with these tier one suppliers for many years and builds on that. So we factor that into our valuation. That leads us to our view that the market is underestimating the strength and duration of this process. So we think the market over time will upgrade its perception of Dicker Data, which is a point that another investor that I read about over the break, he makes a good point about perceptions and market perceptions. And I'd never heard of this guy, Robert Wilson, little known but amazingly successful investor, started out with $15,000 in the mid-1950s and turned that into $800 million by the mid-1980s. Anyway, he said the only way one makes money in the market is when the perception of a stock changes. And so we really agree with that statement, and hence why we've talked so much in the past about undervalued quality, how we think about identifying, measuring, and ultimately making money through this hunt for undervalued quality companies. Companies for one reason or another are being overlooked or discounted, and we try and take advantage of these opportunities and buy these companies or ultimately sell them where we think perceptions will change. And experience and skill that we've had over many years guides us in this, and our quality filters are the guardrails that keep us on the straight and narrow as we go through this.
That's great, Matt, and I'm very keen to hear more of your predictions. But before we do that, I'd like to revisit last year's Q&A from around this time. What were you saying back then, and more importantly, were you right?
Yeah, thanks, Jen. So my co-portfolio manager, Emma Fisher, and I, we made some predictions this time last year. So the first one, we said, COVID-19, we could see the light at the end of the tunnel. We said that we were getting on top of this. The vaccines were coming, no more lockdowns. So we were totally wrong. The vaccines took a little bit longer to come. Lockdowns still occurred. We really didn't understand the Delta variant hadn't poked its head at that point. But we were wrong, but also strangely right, because despite Delta and Omicron and further lockdowns, the market continued to look past the variants and predict better times ahead, just as we were thinking ourselves. And so, we've now at the stage where, again, I'll talk maybe a little bit more, but we're again at the stage where we think we're pretty positive about the future, from here. The other thing we talked about was the M&A boom. And we think we got this right, and no great blinding insight here or no great achievement. Given the abundance of liquidity, low interest rates and strong balance sheets, it's pretty obvious conclusion. But gee, what a year it was though. When you look at the amount of deals, the size of the deals, it's a record year in at least the last 20 years for M&A. So we were right on that. We ultimately said, the market should continue to do well in calendar year 21. And so we got that right. Despite having a massive rally from the March 2020 lows, we felt that there was still more in it. And really this was driven by our view on the virus, and also the fact that just the lack of alternatives. The market just seemed a good place, and the M&A boom. So it all led us to think, we were going to have a good 21. And that's what's occurred. The ASX 200 was up 17% total return for the calendar year.
Yeah.
As the year sorry, Jen.
Sorry, I thought you finished.
No. As the as the year went on, we warned that if interest rates shifted up, this was bad news for those areas of the market that rely on a really low discount rate. And so this prediction, as the year went on, was probably mixed, because it was definitely wrong in those long duration assets, the infrastructure type assets. So we saw plenty of deals, Sydney Airport being bid for, AusNet, Telstra mobile towers, plenty of really high prices paid for these long duration assets. So we're wrong there. But towards the back end of the year, the high flying growth and loss making tech really took a hit, and this was because of the shift in interest rates and the rolling impact that has on the valuations and the future outlook for these companies. So I think that prediction was a bit mixed.
So looking forward now, what do you see for the year ahead?
Look, I think, after a decade of interest rates heading in one direction, it really does feel, Jen, that we are at a really interesting juncture. The dominant narrative right now, obviously, is inflation occurring and tapering from the central banks around the world, which leads to higher rates. And so this is consensus and really dominating the market's thinking going forward. I don't know what's really going to happen, how high rates are going to go, where inflation is going to go. It's very hard to try and guess that. But I guess our prediction is that this year we get a hell of a lot more volatility in the market. Last year the S&P 500 had, I think, the fewest drawdowns of more than 5% in its history almost. It was one of the the more, steadier climbs upwards that we've seen in the S&P 500 history. So we think, markets don't like inflation, but not all inflation is bad. It just depends how much. You look at the differing levels of inflation over the years. The sweet spot is where we've been the last decade, 0 to 3% inflation. If it goes higher for prolonged periods, then history suggests things are much more difficult on the market. And so, look, we predict a lot of volatility in the market this year as investors sort of worry about this. What does that mean for our portfolio? I guess, short term, we're looking at unintended bets and consequences of higher rates. And I guess, there's a lot of easy statements, people make that, well, when inflation does this, you buy or sell that in the market. And for one example would be banks, generally, historically, and theoretically, higher inflation is better for banks because they can increase the price of what they're selling, loans. So they can, in Australia's case, let's say the mortgages, your mortgage rate will go up. They can increase the spread at what they borrow at and then what they lend out at. And so hence their margins improve. And so profits should improve. But that's just taking inflation in isolation, and things don't happen in isolation. And this is why we still remain pretty cautious on the major banks and, in fact, underweight in the Airlie Australian Share Fund. Because we think, there's other factors at play. There's the fact that there'll be demand destruction for mortgages as interest rates go higher. The housing market has been very strong. We think that'll come off. And secondly, we think there's the level of competition in the market now is just unprecedented. And we've seen that evidenced in the latest quarterly margin efforts by the banks. And you combine all that with the banks being the valuation on a pre-provisioning level being at 20-year highs, over 20-year highs. So putting all that together, it doesn't make a compelling case for us at this point in the banks. So that's the first thing. We think volatility will increase. Second one is the M&A boom will continue. I mean, right up to Christmas, we saw some big deals. CSL, massive equity raising of over $6 billion, one of the biggest in the Aussie market. And interestingly, quite a few of our portfolio holdings made acquisitions in the last 3 to 6 months. CSL, Aristocrat, EBOS, Horizon, Nick Scali, Helios. And I think that reflects the strong balance sheets that, our companies have in the portfolio, and, they're seeing opportunities. Look, generally, we're pretty nervous and skeptical about acquisitions, particularly at this point in the cycle, if we do get an upward trend in interest rates. Look, we could see the strategic merit in each deal on its own, but I guess we were really least excited about Horizon purchase of One Rail. We think they overpaid, and we acted on that. And we're most excited about the Nick Scali purchase of Plush sofas. Plenty of synergies to come there. Look, the other prediction we'll make is that I think it's going to be a very difficult second half 22 profit season. So the period we're sort of in right now, and that's due to supply chain issues, staff shortages that we're seeing throughout Australia. And then if Omicron, gets into China, that will have implications for supply chain as well. That could prolong the issue. So we think the second half 22 profit season is going to be pretty tough. And again, that goes to the volatility in the market. We think this will cause quite a bit more volatility as we move into 2022. But look, I don't want to sound too negative, because overall, we think that 2022 can be another reasonable year for the market overall. Omicron may hasten the end of the pandemic. Interest rates may go up, but they may still remain relatively low. Balance sheets are still really strong. Fiscal spending will step up as monetary policy gets, pulled back. And again, I'll point to the lack of alternatives. Where do investors put their money to generate a reasonable return? And quality companies can still provide reasonable, again, growing levels of dividend income. So we think, there's a good chance that, maybe we don't do 17% again, but, if I was forced to pick a number, why not an average year, for the market of, a 7 or 8% total return? I don't feel that that's totally unreasonable.
Thanks, Matt. That's really great. I'd like to bring it down to the stock level now. Do you have any predictions around some of the stocks in the current portfolio?
Yeah, so plenty, I guess. But, bringing it to some of the themes we've talked about, the continuation of the M&A boom. I think Tabcorp demerging lotteries mid-year. We've spoken about this quite a bit to our unit holders. I think that's going to be interesting. Medium-term, lotteries is an obvious takeover target. But actually, even the wagering business that is also, becomes the other part of, becomes the Tabcorp business. We think that even that will see interest. So, and look, we've already had a private equity approach for Smart Group, which is in the portfolio. That deal fell over, but these things have a habit of coming back. So I think the M&A boom will continue. But usually when you get bid for companies, in your portfolio, it's sometimes the very least expected companies. If we were doing this video, Jen, a month ago, I would have said Mineral Resources was a real, a really strong pick of ours, but it's had a fantastic December, up nearly 30% since my colleague Emma Fisher wrote to unit holders pointing out how cheap the implied lithium business was within Mineral Resources. So, that's gotten recognised pretty quickly, but still medium, longer term, Mineral Resources is okay, but it's had a very strong run. We think this green metal frenzy, may continue to run, but we find it very hard to find attractively priced opportunities. And when I say green metals, I'm talking about the lithium, cobalt, nickel companies. And I think some consolidation of these stocks might be in order, which sort of brings me to our biggest miss of the year last year, Lynas, which in a similar vein produces rare earth metals, which again are sort of used in EVs and other applications. Lynas were doing work on the Wesfarmers bid a year or two back. The Wesfarmers bidding for the company actually really solidified our view. But I guess the thing that held us back was what was going on in Malaysia at their operations there. We really didn't feel we had a handle on that, and probably really needed to visit the Malaysia to understand it. But unfortunately, that wasn't. We weren't able to do that during the COVID. So that was one that got away from us. The other prediction I'd make in the portfolio, is value stocks will continue to run. The ever widening valuation disparity between the high and low PE companies has continued in 2021. I think there's room for that to narrow if indeed this higher interest rate scenario continues. Cyclical companies should rally, and we've seen some evidence of that already. So in the portfolio, we quite like Seven Group. We think that looks very interesting. Consensus has the stock on a PE of 12 times, price earnings ratio of 12. That's a near 60% discount to the industrial market average. And the businesses within Seven Group are way better than a 60% discount. In fact, they're market businesses. Their major business being Westtrac, which has the Caterpillar franchise for WA and New South Wales. This is a fantastic business, has had steady growth for a number of years, and it produces high returns. The other big part of the business is their ownership in Boral, and most other building material companies in Australia would trade on well north of 12 times, and we think Boral has improvement in it over time, and so we think that's another source of upside for Seven Group. But I guess whatever the sort of the macro influences we predict companies. We predict that could happen and what may happen. We find, I always find that over time, the really skillful quality management teams can grow through any kind of scenarios. And stocks in the portfolio, such as PWR Holdings, which is the high-tech cooling systems for the automotive, and now the emerging technologies part of its business, where it's producing high-tech cooling systems for aerospace and military use. We think that has a big runway. We're quite excited about the medium and long-term growth for that company. And the stock I mentioned before, Dicker Data, I think, as I said, their industry is as companies just digitize every part of their process. Dicker Data are there providing the shovels, if you like, in that, for that kind of comparison in this gold rush. And we think they have an exciting time ahead of them as well. So, good companies that can grow. It really doesn't matter, we think, generally what the macro, influence is going to be. Good management teams can navigate these trickier times and still perform.
Matt, thank you.
Not a problem. Thank you.
And thank you all for watching. As always, if you have any questions, please don't hesitate to contact one of the Magellan distribution team, and feel free to share this update with clients and colleagues as you see fit. Take care and stay safe.